Picture this. You're standing in front of the US debt clock in New York City. The numbers race upwards so fast, you can't even read them. It's a dizzying, hypnotic blur of red digits, a relentless digital waterfall of ink representing a debt so vast it defies comprehension. This isn't just an abstract accounting exercise. It's a real-time measure of a promise made on behalf of every citizen. The speed is staggering. In the time it takes for a single heartbeat, the debt grows by more than the average American earns in a year. It's a financial vortex, spinning faster and faster with each passing moment. As of early 2025, the U.S. national debt has soared past $37.4 trillion. To put that into perspective, if you spent $1 every single second, it would take you over 1.1 million years to spend just $1 trillion. Now multiply that by 37. This number has accelerated dramatically, growing by over $66,000 every second. Before you can even finish this sentence, another $500,000 has been added to the pile. It's a sum so large it could fund entire government agencies, build new infrastructure, or solve major social issues. Yet, it represents money already spent. And yet, here's the great paradox that sits at the heart of our modern economy. In the hallowed halls of global finance, a strange calm prevails. America, the world's biggest debtor, is simultaneously considered the world's safest borrower. Why? Because U.S. Treasury bonds, the IOUs our government issues, are the bedrock of the entire global financial system. They are the ultimate safe haven asset. So nations like Japan and China, major corporations, and even your own pension fund are all lining up, eager to lend America more money. They are betting on the unwavering full faith and credit of the U.S. government, a promise that America will always, always pay its bills. This creates a dizzying contradiction. On one hand, a mountain of debt so high it seems impossible to ever repay. On the other, a line of creditors so long it seems the money will never run out. So, which is it? Can this debt ever really be paid off? Is it a manageable, even necessary tool for a modern superpower? Or is America sitting on a ticking time bomb, a financial doomsday clock counting down to a global economic cataclysm? A bomb that, if it detonates, won't just cripple the United States, but could trigger a chain reaction, plunging the entire interconnected world into a depression that would make 2008 look like a minor tremor. By the end of this video, we'll peel back the layers of this mystery. We will go beyond the headlines and the political shouting matches to reveal the terrifying truth. The immediate danger isn't just the size of the debt. The real threat lies in the intricate, fragile architecture that supports it. It's a system built on one crucial, intangible ingredient: confidence. A system that makes the unmanageable seem manageable, the unsustainable seem sustainable, right up until the moment it suddenly isn't. We'll explore the mechanics that keep the machine running and the potential black swan events that could bring it all crashing down. This is the invisible framework that dictates the value of the money in your pocket and the stability of the global order. And that's the system we're decoding today, here at Decoding Point. Let's start with the outer skin of the onion, the sheer size. The U.S. national debt is now $37.4 trillion. That's the highest it has ever been in dollar terms. Every single day, the government pays nearly $3 billion just in interest. That's money not going to schools, hospitals, or infrastructure, but simply to service old loans. For perspective, that's more than the U.S. spends daily on its military. Here's a picture to help. If you stacked $1 bills to represent the debt, the pile would reach the moon and back several times. Shocking, right? But here's the catch. Those numbers don't actually tell the full story. Because in economics, it's not just about how much you owe, it's about how big you are compared to what you owe. This brings us to the first deeper layer: history. Many people believe America has paid off massive debts before. That's a myth. After World War II, debt hit 106% of GDP higher than today. But the U.S. didn't pay it down through surpluses. It outgrew it. Here's how. The economy exploded thanks to the post-war boom. GDP grew much faster than debt. Moderate inflation helped shrink the value of what was owed. By the 1972nd, the debt-to-GDP ratio had fallen below 30% without paying off the principal. That's the key lesson. It's not about eliminating debt. It's about making it manageable relative to the size of the economy. So the natural question is, can America repeat that trick today? But this is where the story takes a darker turn, where the real danger begins. The strategies that worked in the past relied on a key assumption that we could simply grow our way out of debt. But today's America isn't the post-World War II powerhouse. Back then, the US dominated global manufacturing and the workforce was young and expanding. We were playing the game on easy mode. Today, the difficulty has been cranked to the maximum, and the old playbook is dangerously obsolete. A perfect storm of three powerful forces makes this era fundamentally different and far more perilous than any before. First, slower growth. In the decades after World War II, the US economy regularly grew at 4 or 5% a year. This explosive growth acted like a powerful tide, shrinking the relative size of our national debt, but that tide has gone out. Today, long-term growth projections are stuck in the slow lane, around a modest 2% annually. This isn't just an abstract number, it means the economic pie is expanding too slowly to outpace our growing obligations, making it nearly impossible to simply grow our way out of the problem. Second, demographics. The massive baby boomer generation, which for decades powered the economy, is now retiring at a rate of 10,000 people per day. This creates a seismic shift as the costs for Social Security and Medicare skyrocket. This isn't discretionary spending, it's mandatory, baked into the system. Projections show these programs, along with interest on the debt, will consume nearly all federal revenue within a few decades, leaving almost nothing for everything else the government does. And third, the knockout punch, rising interest rates. For over a decade, the government could borrow money almost for free. With interest rates near zero, adding trillions to the debt seemed painless. But that era is over. To combat soaring inflation, the Federal Reserve hiked rates aggressively. The consequences are catastrophic. In 2024, the government is projected to spend nearly $900 billion just on interest. That's more than the entire defense budget, more than it spends on Medicaid. It's a staggering sum of money that builds nothing and helps no one. And this is the trap, what economists call the debt spiral. The more we borrow, the higher our interest payments become. The higher our interest payments, the more we have to borrow just to cover them. It's a vicious, self-perpetuating cycle. Every dollar spent on interest is a dollar that can't be used to repair a bridge, fund cancer research, or strengthen our military. We are now borrowing money just to pay back the interest on money we've already borrowed, a financial doom loop that threatens to consume our economic future. Quick pause to clear confusion. The deficit equals the yearly shortfall between spending and revenue. The debt equals the accumulation of all past deficits. In 2024 alone, the U.S. ran a deficit of about $1.6 trillion. That added straight to the debt pile. So when politicians say, we'll reduce the deficit, that just slows the growth of the debt, it doesn't reduce the debt itself. Now we peel deeper into the central paradox of America's debt. We've seen the staggering numbers and the seemingly unsustainable path. Logically, any other entity with this balance sheet would be seen as a catastrophic risk. Lenders would flee and bankruptcy would be inevitable. And yet, for the United States, the opposite happens. The world lines up to lend it more money. Why? The answer is rooted in a decision made over 75 years ago. It all comes down to the unique, unparalleled power of the US dollar. After as a WY2 the Bretton Woods Agreement made the dollar the world's reserve currency. Even after the US left the gold standard in 1971, its dominance grew. Today, the dollar makes up 58% of global foreign exchange reserves. Nearly 90% of all currency trades involve the dollar, making it the indispensable lubricant of global commerce. and crucial commodities, like oil, are priced in dollars. This means countries need dollars to participate in the global economy, creating a constant, structural demand for American currency. This global demand for dollars has to go somewhere. Its primary destination is U.S. government debt, treasury bonds. These are considered the world's ultimate safe asset. Why? The U.S. has the world's largest economy and has never defaulted. Crucially, its debt is issued in a currency it can print at will, making a nominal default almost impossible. For global investors, from the central banks of Japan and China to European pension funds, buying treasuries is a practical necessity. They are parking their capital in the only market deep and liquid enough to handle it. And this brings us to the core of the paradox. This system grants the United States what's famously been called an exorbitant privilege. It's the unique ability to buy what it wants from the world by printing its own money. It allows the U.S. to run massive trade deficits, consuming more than it produces and financing its government spending with low-interest loans from the rest of the world. In essence, the world works, saves in dollars, and then lends those dollars back to America. But here's the terrifying flip side. This privilege isn't a right. It's a fragile consensus resting entirely on global confidence. And confidence can disappear in an instant. What happens if that trust evaporates? If a self-inflicted wound like a debt default shatters the illusion of safety, the safe asset would no longer be safe. A global sell-off of U.S. treasuries would cause interest rates to spike and the dollar to crash. It wouldn't just be an American crisis, it would be a global financial meltdown. Another myth to bust. China owns America. Not true. About 70-75% of U.S. public debt is held domestically by the Federal Reserve, mutual funds, pensions, and ordinary Americans. About 23-30% is foreign-owned. The largest holder is Japan, not China. China owns less than $800 billion, under 9% of foreign holdings. So the real risk isn't China pulling the plug. It's the global system itself slowly diversifying away from the dollar. Here's the core of the onion, the terrifying truth. The U.S. debt isn't just a mountain of numbers. It's a fragile confidence game. As long as the world believes U.S. treasuries are safe, America can borrow endlessly. But if that belief cracks because of runaway deficits, political dysfunction, or global alternatives, the system could unravel overnight. Economists call this a Minsky moment, a sudden collapse of confidence after years of apparent stability. Imagine it. Foreign investors dump U.S. bonds. Interest rates spike. The dollar plunges. Credit dries up. The global economy, which depends on U.S. debt as its anchor, is thrown into chaos. That's the terrifying part. Not the number itself, but how fragile the entire system is. Let's bring this home. Opportunity cost. Nearly $1 trillion in annual interest could fund universal preschool, fix America's infrastructure, or cut taxes. Instead, it goes to bondholders. Crowding out. When the government borrows, it competes with families and businesses for credit, pushing up mortgage and loan costs. Intergenerational burden. Today's borrowing is tomorrow's taxes or tomorrow's crisis for our children. This isn't abstract. It's your rent, your healthcare, your paycheck. Here's the answer, clear and honest. The U.S. debt will never be paid off like a household mortgage. That's not how sovereign finance works. The options are: 1. Outgrow it. GDP rises faster than debt possible, but harder today. 2. Inflate it away. Pay back with weaker dollars. 3. Financial repression. Keep rates low to manage costs. 4. Default. Unlikely, catastrophic, and unnecessary for a nation that issues its own currency. So no, the debt won't vanish. It will be managed until the system itself is tested. So, will U.S. debt ever be paid? The sobering truth? No. Not in our lifetime. Not in our children's. The terrifying part isn't the number, it's the fragile faith holding the system together. The question isn't, will the U.S. pay off its debt? It's how long before the world stops believing it can? And when that day comes, the shockwaves won't just hit Washington. They'll hit all of us. What do you think? Is America's debt sustainable, or are we heading for a reckoning? Comment below. I read every single one. Today, we uncovered why U.S. debt is less about dollars and more about fragile trust. But this is just one piece of a bigger puzzle. Because when debt and trust collapse, it can trigger something even darker: depression. We explored that in our earlier video. Are we one step from another Great Depression? Watch it next. You'll see how today's debt spiral connects to tomorrow's potential economic collapse.